Hello and welcome to this instructional video brought to you by Sensa Trader. My name is Matt Williamson, and today we are going to look at some more basics understanding strike price, expiration, and premiums. So if you're just getting started with options, all three of these things are super duper important in order to trade effectively. So we're at here in the dashboard here on Sensa. So we're going to go ahead and go on over to the option chain and just talk about it in terms of options chain for a moment. So we are on Tesla. I'm going to go ahead and take this down to 5 strikes or so just to keep this simple. And we'll put ourselves on Friday's expiration. So I guess we can go ahead and start at expiration since we are up here. So as you may or may not know, options all expire. They have an expiration date somewhere. And those expiration dates can be anywhere from a couple of days all the way out to a couple of years, just depending on how actively traded that particular underlying is. Now, as of right now, we're looking at Tesla. And if you're watching this in like 3 years, Tesla may not exist anymore. Who knows? Or they may have gone to the moon. Pardon the pun. So as of right now, though, they're very, very heavily traded. And we have options all the way out. Keep on clicking here. You can buy options all the way out into 807 days in the future. That's very far out in the future. Okay, that's almost 3 years in the future. Or if you'd rather, you can buy options that are 3 days in the future. Okay, so very, very wide selection of expirations. And they're just located here on this little horizontal menu. Click around and you'll find strikes in a market for all of those different expirations. So we're going to bring it back to April 4th, April 4th here, and take a look. So Tesla currently, it's not trading currently because we are closed, but today Tesla traded down about 1 2/3% to close at 259.16. Okay, we have call options on the left here. We have put options on the right. So just as a brief overview / review, call options give us the right to buy shares. Put options give us the right to sell shares. Okay, that is if we buy the call option or buy the put option, those are the rights that are bestowed upon us. So if we buy a 260 strike call, that strike price, that 260, is the price at which we are allowed to buy Tesla. Okay, if we were to buy the put at the 260 strike, that is the price we are allowed to sell Tesla shares. Okay, so we can buy the shares. If we own the call, that allows us to buy the shares. If we own the put, that allows us to sell the shares. So we're going to keep it on the call side just to keep things simple and straightforward for now. So let's assume for just a moment that we had bought the 260 strike call. That means we have the right to buy Tesla at $260 a share, which is quite a worthless right at this point because Tesla is currently trading at $259 a share. So why on earth would we want to pay $260 for it if we can get it for $259.16? Well, we wouldn't. Okay, and yet the option still costs $10 a share. Why does it cost $10 a share? Because there is a good chance that the right to buy Tesla at $260 a share might be quite valuable here in a short period of time, namely in the next 3 days. Okay, let's say, for example, that Tesla rallied itself on up to about $280 a share. Well, at that point, the right to buy the shares at $260 would be worth a whole heck of a lot more. It would actually be worth at least $20 per share. So instead of this option trading at $10.75, it would be trading at least $20. Okay, and I say at least 20 because there's always going to be a little bit of extra baked in there because probabilities and possibilities don't all go to zero until this thing expires. Okay, as a case in point here, let's say we bought the 250 strike. Okay, the 250 strike allows us to buy, if we bought the call, that 250 strike call allows us to buy Tesla at $250 per share, which is currently trading at $259.16 per share. Okay, so the actual value, the intrinsic, that's a vocabulary word, the intrinsic value of that option is $9.16. If we had the 250 strike, we could buy shares at 250, immediately sell them at $259.16 and make a profit of $9.16. Now, why is that option trading for $16.50? Anybody? Bueller? Because there's extra value in there. There is excess value in there. Okay, there's extra value and there's possibility value in there. And that possibility value, we call it extrinsic. Extrinsic value. If you want the mathematical way to do that, you take the current price of the underlying less the strike, so 259.16 minus 250. That is the intrinsic value. Okay, and then whatever is left over is the extrinsic value. Okay, the extrinsic is the extras, whatever's left over. It's the juice. Sometimes we call it the juice. Okay, and that is what you're paying for the right to have that option for the next 3 days. Okay, having the option to do that, to buy shares at 250 over the next 3 days is worth quite a bit. In fact, it's worth about $7 per share. Okay, so when you buy an option, you're going to be able to pay, or you're going to be paying rather, some extra amount of money. You're going to be buying some intrinsic value. Sometimes you might not be buying any intrinsic value, but you'll be buying some intrinsic value and you'll be paying some extra value. So it's important to know that, or understand the difference between the intrinsic and the extrinsic. Okay, any strike that is out of the money, which means there is no intrinsic value, all of these things above the current market price on the call side have no intrinsic value. Okay, if we took the stock price at 259 and subtracted 265 from it, we would have a negative number. Okay, there is no intrinsic value in the 265s. If we bought the 265s, exercised the right to buy shares at 265, and then immediately sold them at 259, well, we would be quite a bonehead, wouldn't we? That would not be a good move. We would immediately lose money. There's no intrinsic value there. So that $8.40, that's all extra. That's all possibility. That is all time value. That's all juice. That's all probability. That's all guesswork that the price of Tesla might go up past 265. In fact, it has to go up so far past 265 that we clear this amount. If you pay $8.40 a share to have the right to buy it at 265, we really needed to go to what? 273.40. That's before we break even. Okay, so it's important to understand the intrinsic, the extrinsic, and the premiums that you're paying for all those things. The further out in time you go, the more extrinsic value rather you're going to see in the options. Okay, that same 250 strike call option, instead of it being worth $9.16, which is its intrinsic value, it's now trading for $43. Because there's so much time, there's so much that can happen with Tesla between now and 108 days from now. The excess value is almost $30 per share. Right? The intrinsic value is $9.16. Whatever's left over here is the time value. Okay, on the put side, it's maybe a little bit more confusing to understand, but it's the same idea. Okay, the 250 strike put, well, that gives us the right to sell shares at 250, which we don't want to do because Tesla's trading at 259. Why would we want to sell shares at 250? So this is all extrinsic value. There is no intrinsic value here. The 270, on the other hand, we could buy this put option, exercise it to sell our shares at 270. It's trading for let's just call it 259. So there's $11 of intrinsic value there. But the option is trading for considerably more than $11. So there's an extrinsic value of, somewhere in the neighborhood of $30 or so. Okay, so a lot of extra juice over here that is not intrinsic value. So when you're buying options, make sure you understand the intrinsic and extrinsic portion of what you were buying. All right, that's going to do it for this lesson. Hope that was entertaining and somewhat educational. All right, we'll catch you in the next one. Take care.